Yes, good morning, everybody. Welcome to this seminar on customs and what you need to do now with regard to Brexit. You've seen my video. I'll politely turn that off for now so that you don't get distracted by my little toings and froings in the top corner there. So what you need to know now and how you need to progress with regard to being prepared for the UK leaving EU. What we'll be talking through this morning is things you need to do now, roughly 4 weeks away from the 1st of January, the D-Day, and Ben updating us on how the negotiations are going there, and the pizzas are going well. But until we get some definitive answers from those negotiations, there's still quite a lot to be advised and guidance supplied on. But I'll take you through the various sections of the next 45, 50 minutes or so. Things you need to know now. We're looking at importing goods into Great Britain. The distinction, obviously, with the situation in the Northern Ireland Protocol removes the UK aspect of that. Exporting goods from Great Britain. We'll have a brief look at Northern Ireland and how that fits in at the moment as we speak. We look at the transition period. This is the UK transition. I know we've probably seen quite a few transitions since the Brexit vote. The one that is due to start from the 1st of January 2021 is purely a UK transition, nothing really to do with how the EU is going to operate. And just as a final cap on the event, we'll look at the border operating model, which really is the ultimate guidance as we speak for moving goods to and from the UK, including the EU. So first of all, some very basic things. I've slightly sort of changed some of the presentation that I was originally going to give, and instead of focusing entirely on some of the Brexit areas, quite a lot of the inquiries I've been getting recently from members are really starting at quite a low level and asking about customs procedures and processes, being unfamiliar, as I can put it, with how imports and exports work. If a business has been simply dealing with the EU, a lot of this process and paperwork is brand new to them. So first of all, I'll start with some very basic information. In order to do business either in or out of the UK, you need to be registered with an EORI number, Economic Operator Identification and Registration Number. Now, that number should have been allocated to you automatically if you're VAT registered. If not, you would have needed to actually apply for that EORI number in order to make import and or export declarations. You can't make any import or export declarations without a registered EORI number. The system just will not accept that number. The first area that I think needs to be discussed, and most businesses will be in a situation where whatever agreements the business might have in place for terms of trade, in-court terms, if you want to call them that, delivery terms specifically, those agreements, as we speak now and historically, have been largely centered around movement of goods, transport, insurance, etc. The customs aspect of it has never really played a part, because as one of the 28 member states that we currently are, there are no customs processes to be fulfilled if you're moving goods between those 28 member states. It's definitely worthwhile having a look, if you haven't already done so, at those in-court terms and terms of trade that you've got with your suppliers or your customers. Essentially, it will dictate, or they will dictate, who is responsible for which part of the paperwork that customs will necessarily bring on the 1st of January. So, for example, I've used two extremes, essentially. If you are either buying or selling goods ex works, if we use the example of selling goods ex works, then your customer is responsible for the whole of the transport of the goods back to their premises, the transport costs, the insurance costs, but also from the 1st of January, they will be responsible for customs declarations, which means they must be in a position to make a customs declaration for the goods that are leaving the UK. On the opposite side of the fence, if you have terms of trade which are delivered duty paid, then it's the shipper's responsibility, and you as the seller, if you're delivering delivered duty paid, it's you as the seller who has to complete all the paperwork and absorb all of the costs for getting the goods to your end user, your customer. And obviously with Incoterms, the new Incoterms 2020, there are lots of different Incoterms in between there, which slides the responsibility line up and down depending on where you sit at the moment. So the first bit of advice I would give to anybody currently dealing with the EU, either importing or exporting, is to have a look at those agreements, see what terms of trade you've signed up to or agreed with your customers or suppliers, just to establish who has the responsibility for making either import entries or export entries, EU-wide or UK-wide. Check the UK global tariff. Now, there's the UK global tariff is set to replace the EU's own tariff that we operate under at the moment. And I've no doubt that if you're importing goods from third countries, you're acutely aware of what customs duties are applicable to those goods on arrival at the UK. We follow the EU tariff, but the UK global tariff, which has been published and is available online through the gov.uk website, will allow you to check what the difference might be or will be come the 1st of January for the UK tariff itself. Most of the duty rates that are in the UK tariff are significantly lower, or certainly lower, than the EU's own tariff. So it's worthwhile just checking to see what those tariffs might be come the 1st of January, when goods that you are receiving from the EU into the UK will need a customs declaration, and any tariff and VAT will need to be paid on arrival or deferred in one way, shape or another. I'll talk a little bit more about deferment in a later slide. But it's important that you check the tariff, not only in order to see what the duty rate might be for the goods that you're bringing in from the EU, but also to see if there are any license requirements attached to the commodity code that you're bringing in. HMRC is not responsible for issuing license. You need to go to the relevant other government departments, Department for Business, Energy, Industrial Strategy, International Trade, the Home Office of Rural Payments Agency. All of those are involved in the issuing of license. But if the commodity code shows that you do need a license, you will not be able to import those goods into the UK unless that license is in place. The declaration that's made on your behalf reflects that. From a declaration point of view, once we leave on the 1st of January, and I know we have the trade talks ongoing at the moment, and we may hear something very, very shortly on any agreement or the fact that they haven't reached an agreement. Whatever that agreement brings, it will only reduce or mitigate the costs of import duty and perhaps VAT, etc. It will not remove the need for import and export declarations between goods that move to and from the UK and the EU. That is a given. We're leaving the customs union as such, and at the best case scenario, the only thing you'll need to do is make declarations. But It's a basic requirement that goods will not leave or enter the UK unless a customs declaration is made in one shape or form. The entry is made on what we would refer to as a single administrative document, SAD document. In the UK, that is Form C88. The same form is used for imports as is for exports. It's currently the same throughout the EU. Same form, that's not going to change from the 1st of January. Same form, same format. Now, this is what a paper declaration looks like, and I use this document advisedly, really, because ultimately this is a referral document you can use if you're looking to understand what the different boxes on a customs declaration might mean. I think there are something like 54 individual boxes. Not all of those need to be completed, by the way, for every declaration. Each individual product will have its own requirements, box number wise, but it is a useful tool to see what those boxes actually mean if you're needing to complete them. And I'll talk a little bit about whether you've considered making your own declarations, because HMRC have put out quite a bit of publicity over the last 2 years or so, asking businesses to consider whether they want to make their own declarations or use a third party to do that. So it's a useful document to have just to understand what's going on with a customs declaration. I must say that the actual reality of looking at a customs declaration is an electronic screen these days, which is largely undecipherable. And this document just helps if you're looking to understand some of that information. So who's who? Who can make the declaration? If you're the importer or the exporter of the goods, you can make the declaration yourself. If you're an agent set up purely to make customs declarations on behalf of importers and exporters and manufacturers, the agent can be the declarant. The forwarder, the haulier who's moving your goods, also can offer that service of making customs declarations on your behalf. And we have a large area there, the fast parcel operators, who obviously move goods quite frequently, and they would make declarations on your behalf. Now, the customs agent is the normal person to make declarations, third-party business to make declarations on behalf of an exporter or an importer. I will say that the vast majority of businesses have employed customs agents rather than making declarations in-house within the business. Now that situation may change, especially for some of the larger businesses who are looking at quite a large increase in volume of declarations that need to be made now that goods moving to and from Europe will need import and export declarations. But that can be quite an expensive situation, in the sense that certainly for import declarations, you do need to expend some money on getting badges, which you need to pay for. You need to perhaps buy some software, and you also need to train your staff in what can be a tricky situation in understanding how to make certainly an import declaration. I'll talk a little bit about export declarations further on in the presentation. But if you employ a customs agent, and I would suggest anybody who hasn't looked at this area but is now understanding that from the 1st of January, perhaps they will need to be making customs declarations in one way, shape or form. Customs agent can act in two different areas: direct representation, which means they're acting on your behalf, and the HMRC will look to you as the importer or exporter should anything go wrong with the data that's put on the customs declaration. Or the less popular, certainly less popular with customs agents, is the indirect representation, where they do business on your behalf, but on their own behalf also. So they become jointly and severally liable for any customs debt that might arise from any issues that HMRC might raise. So it's usual for most businesses to use a customs agent. And my advice would be that if you're brand new to customs procedures, then you need to be looking to speak to a customs agent of some description, or your freight forwarder perhaps who's moving your goods at the moment, to make sure that they can make declarations on your behalf. It's not just a question of the ability of the declarant, the third-party declarant, to make that declaration on your behalf. It's a capacity issue as well, and Brexit has thrown up a huge increase in the number of declarations. Something like 55 million to 60 million declarations as we speak on an annual basis going to customs, HMRC. That's going to shoot up to somewhere around 250 million. So whilst your customs agent or freight forwarder might be able to make declarations on your behalf, it's wise to have a conversation with them just to make sure that they can deal with the increase that you might be presenting them with. I've touched on the making of your own declarations. It's a lot more tricky for for imports, and the cost and training that's required. If you haven't already gone down that line and have staff in place who are able to make the declaration on the business behalf, then you're certainly not going to be able to do that by the 1st of January. It's quite a lengthy process. Having said that, the government have provided some funding for businesses who want to go down the route of making their own declarations, so they can perhaps save themselves some money. So they are the options essentially that you have for making declarations. Duty deferment accounts. Now, this has just recently changed, certainly within the last 2 weeks. For regular importers of goods, having to pay the customs duty and import VAT can be quite tricky if you haven't got a deferment account, in the sense of you must pay any appropriate duties and import taxes on the goods before they're released by customs. What a duty deferment account does is you set this up with HMRC, and it's an automatic process once you're authorised that any monies that is due to HMRC is collected from you once a month for the full month value-wise of those imports. It's changed very recently in the sense that you usually had to put up a customs guarantee. In other words, customs would give you that deferment account on the proviso that you had, say, a bank guarantee in place that if anything happened to the business and there was some money outstanding in the deferment account, then HMRC would call on that guarantee. As one of the facilitations that the government has put in place for Brexit to help with Brexit is that you can now apply for a duty deferment account free of any kind of guarantee. Now, you do have to meet some compliance and solvency criteria in order to qualify for that. But basically, if you've got a reasonable history and no major debts with HMRC, you should qualify for the duty deferment account without a guarantee. And just out of interest, for those businesses who are listening, who already have a duty deferment account and have a guarantee in place to maintain that, you can apply to have the waiver with effect from the 1st of January. So that may save you some money, but certainly for a lot of the facilitations that HMRC offer customs-wise, having a duty deferment account in place can be something that they insist upon. So it's worthwhile doing. It's free. The only cost initially was the deferment account, but the application is free, the authorization is free, and now there's no cost with the guarantee having been removed. It has a benefit of delaying the payment of any import duty and any VAT by anything up to 15 days, because the payment is taken out of your business bank account on the 15th day of each month. So just by way of calculation, if goods come in on the 1st of a particular month, you get that full month before you have to pay it, and another 15 days taking you up to 45 days. If it comes in the middle of the month, then you only get the 15 days credit, if I can put it that way. But it's still worth having, and something that is now a lot easier to apply for and cheaper to put in place. So We look at imports and the impact that the UK exiting the EU will bring, Brexit in its common parlance. And again, these are some of the very basic areas that I've been getting a lot of questions on, asking for assistance on what a customs declaration is, how you go about doing it, and what are the key components of that declaration, so that businesses are prepared and understand what their obligations are. Three key areas of a customs declaration that is you really need to concentrate on, especially as an importer, because these are the areas that HMRC and a customs audit officer will concentrate on when they carry out a customs audit, for those of you who've been unlucky enough to have one over the last sort of 10 years or so. But we look at classification of the goods, the valuation of the goods, and the origin of the goods. And we'll take those one by one. So classification, sometimes referred to as a commodity code, classification code, harmonized code. It does have various different names, but essentially it's the 8 or 10-digit code number that needs to go on every customs declaration, be it import or export. Just by way of explanation with regard to the difference in the 8-digit and 10 digits, if you are exporting any goods from the UK, it will require an 8-digit commodity code. Exports require an 8-digit commodity code. And again, I touched on the UK global tariff. You can find it's quite a useful tool. You can put a description in that tariff, and it will take you towards the commodity code that applies to those goods. Or if you've got an 8-digit or a 10-digit commodity code, you can put the digits into the global tariff checker, and it will tell you what those goods relate to, or what that commodity code relates to. Because you do need to check that the commodity codes perhaps that you've been used to using, if you have got them on a database within your business, you have to check that they're up to date and still being used, essentially. But for an export, the coffee percolator that I've got symbolized there, you would put 84198120, which relates to coffee making machines, non-electric coffee making machines. Same percolator imported from outside the UK, and I've changed the terms, even though at the moment, if you're making imports from outside the EU, then we obviously still operating on the EU basis, but I've changed this just recently to reflect the situation with regard to the UK. It will have a 10-digit commodity code, same 8 digits that you find on there, with an extra 2 zeros at the end. And with the global tariff, it will tell you which digits you need to add should there be any differences on those last 2 digits. You can find that from the UK global tariff. And it's a useful thing to actually have a look at. And one of the areas that I've had quite a lot of involvement with businesses is looking at their current commodity code database, just to make sure that it's up to date before they start looking at perhaps the costs of importing goods from the UK with the appropriate commodity code to establish whether there's any duty to be paid on the goods that they're now bringing in from the UK, from the EU. So why is the commodity code important? The commodity code determines how much duty is applicable to those particular goods. Each one of those can be different. And certainly one of the advantages of the UK global tariff checker is when you go on there and put in your commodity codes, it has a comparative with the EU commodity code and the duty that you would be due to pay on the EU tariff. So you can see almost instantly the differences between the UK tariff and the current EU tariff itself. So it will tell you how much you're going to be charged by way of import duty or VAT. It provides trade statistics for the UK. It also importantly indicates whether you need an export or an import license. The commodity code will indicate amongst its narrative in there that in order to move these goods in or out of the UK, you need to apply and have a license in place. It also identifies goods that have special or import or export arrangements. So if a particular type of good might not need a license, but it might need certain types of security or certain types of labeling or certain types of packaging for it to be acceptable to carry out the journey. The process of finding the correct commodity code is referred to as classification. Can be quite a tricky area, and there are lots of aspects where you might think, if you're looking at this, that your commodity codes could be either or and could fall in between stools, if I can put it that way. So you can use the government tariffs from the 1st of January. That will indicate to you, A, that the description of the goods matches your information and what duties and VAT you're likely to have to pay on import. If you're still unsure about that, the HMRC does offer a classification helpline. It's email only. It used to be available by telephone, but you can now email the helpline at that address, and they will give you some advice on how that classification should look. What you need to do is give a full description of the goods, indicate which classification, which tariff code you think is the right one, and they will give you their opinion. Now, it's not legally binding in that situation. If you did require something a little bit more strong, in other words, let's just say that the two customs commodity codes that you were looking at, one of them had a nil rate of duty and the other that your goods might fit into had a 10 or 15% duty, then you might want to make absolutely sure that you're making the right choice in classifying those goods. So you can apply for what used to be called a binding tariff information under the EU regulations. From the 1st of January will be renamed the Advanced Tariff Ruling Decision, but it's still the same thing. You can get in touch with HMRC, apply for an advanced tariff ruling. They will require probably more information about the makeup and the story behind the goods, and perhaps even ask for a sample of those goods. But once you've got that, you can be sure that the tariff code you're using, commodity code you're using, is accepted by UK Customs. The other area of importance on a customs declaration is the valuation. Now, you might think that value of imported goods in particular, and I'm talking about imports in particular with regard to valuation, because if you think about making an export declaration, again, I'll touch on that later on, there's no customs duties attached to any export of goods. There are implications around VAT and not charging it, but that's a separate issue. So we're looking at the valuation of imported goods here. It's important that you as a business, because you'll be the person either making the declarations if you're one of the few who opt for that, or if you're using a third-party customs agent to do it on your behalf. It's important that you get the valuation right. And the usual term that is used is the CIF value, the cost of the goods, the insurance that's covered the goods, and the freight charges, as we speak currently to the EU, but that's going to change from the 1st of January to the UK. Essentially, it means, if you go back to the Incoterms that I mentioned, if you're having goods fully delivered by your supplier to your premises in the UK, all of these items will be covered in the cost that they charge to you. The complications come in there when, if you're buying the goods at a certain value, but then you arrange for the transport of the goods from the supplier, and you cover the insurance of the goods en route to your premises. If you get involved in those areas, then you must ensure that any insurance costs and freight charges currently to the EU border, but subsequently from the 1st of January to the UK border, need to be included in there. And valuation can be ever so slightly tricky. I've got to say that there are 6 valuation methods, just very, very briefly. The first method is you need to start with valuation method 1, and if any of those don't fit, you work your way through down to number 6. The first one is the transaction value, which over 90% of all import valuation is based on. It's the cost of the goods to you. And again, it would include the insurance freight. So vast majority of goods is quite simple. But if there's no transaction value, if goods are being moved from, let's just say, associated companies, and there's no value no charge being made for those goods moving from one business to another over international borders, then from a customs point of view, there's no such thing as any goods not having a value. Value has to be ascribed to those goods. So just very, very quickly, the second, if there's no transaction value, then valuation method 2 looks at identifying identical goods which are imported and using the value of those identical goods. And going on to number 3, if you can't find identical goods, then you would move on to similar type of goods, and so on and so forth, until you get to the bottom, which is a fallback valuation method, which is a bespoke way of actually sticking a value against the goods that are coming in, which levies the appropriate customs value on there. The other area that I mentioned, origin. You must declare the origin of the goods that you're importing. Now, there are different types of reasons for having to identify the origin. The first and more obvious one is preferences, where there's some kind of trade agreement in place between certainly the UK at the moment, the EU at the moment, and the EU have something around 70 individual trade agreements whereby preference on customs duties is reduced or taken down to nil. And these are where you need to prove the origin of the goods in order to qualify for the preference. And the UK currently has somewhere around 20 agreements in place. You've probably heard, some of those are quite small, but you've probably heard on the news about the recent agreements which have been drawn up with Japan and Canada as more significant. But it essentially means that if the goods can be proven to originate under the terms of that agreement, preferential rates of duty are applied, and usually those rates are nil. But there are some other aspects of that where you need to prove the origin, which is referred to as non-preference. In other words, it's not reducing the duty rate that's applicable to the import or export, but it is there really to control different kinds of aspects of customs areas, anti-dumping duty, countervailing duty, those kind of things. If there are any embargoes or safeguard measures that are needed to be in place, or quotas, for instance, if there was some kind of quota attached to a particular type of goods, then proving the goods were from the country of origin is required to be put in place to prove that the goods actually originate from the country, whichever country that is involved. From an import preference point of view, goods that qualify from developing countries, that's where all of the agreements are in place, you will be able to import those goods at a reduced rate, often nil, according to the UK global tariff. More on imports, import VAT can be reclaimed as input tax on the next VAT return. So this is how it normally works, but there are going to be quite a few businesses new to this kind of area. Now, you may have come across postponed VAT accounting, PVA, which is going to be introduced from the 1st of January. It essentially means that not having to pay the duty at import, even if you do have a deferment account, bear in mind that it would only be deferred up to 45 days, and you may well be on a quarterly VAT return, which means you're paying the VAT upfront and not being able to claim it back for some while later. The government stepped in and introduced what's called postponed VAT accounting, and by doing this, so you can offset your any VAT liabilities on your VAT return with a nil net effect. So there's no cash flow issue there. All that needs to happen is that on the customs declaration, your agent needs to indicate in box 48, I think it is, that you are operating postponed VAT accounting, and the chief system, customs mainframe computer, will not deduct any VAT from your business or put it into your deferment account for calculation, for collection a little bit later. In normal circumstances, charges are due when the import entry is accepted by customs, but we've talked about the deferment account, and I'll talk about a little bit later on about the temporary measures or transitional measures that are in place from the 1st of January, and the duty deferment account we've talked about, which gives you a cash flow of anything up to 45 days before HMRC take that money out of your account. Now, we're looking at exports. Nothing is going to change with regard to the actual process of making an import declaration or making an export declaration. So in the sense of outside of the transitional arrangements for imports, the national export system is still the way that you need to make a customs declaration. Export entries are pre-lodged into Chief. The goods are arrived when they get to the port. The Chief system, as soon as the arrival message comes through, will look at the declaration and usually gives a permission to progress message. And as soon as the goods have left, the goods departure message is sent into Chief when the goods leave, and that finishes off the movement essentially. It produces the unique reference number, which will be of relevance later on when we look at some of the requirements under the transitional arrangements. But from an export point of view, if you are the exporter, you're getting your forwarder agent to do the declaration on your behalf. That's one part of the equation. It's wise to check that your customer in the EU member state has considered and are set up for making import declarations into the EU. If not, you would be you'd be in a position of having the goods correctly exported from the UK, but they would not move through the EU or past the EU customs border post if your customer is not in position or hasn't already pre-lodged an import entry. So that conversation is quite important to be had. I've talked about preference, bilateral agreements between the EU and certain other countries, and the UK is looking to roll these over. And politicians have said that they're looking to get these agreements rolled over. But again, the UK hasn't got a lot of these in place. And this is where usually your customer is asking you for a certificate of origin, because a preferential duty rate can be claimed at import into the country that you're sending them to. Certificates of origin, there's the different formats, but you can check with your Chamber of Commerce, who will provide those if you get a request for them. But where we will sit with regard to the UK and EU situation is still to be clarified, and we're hoping something will come out of the trade talks that are currently ongoing to establish whether the UK can still form part of the EU agreements or not. That's something to watch out for. So Northern Ireland, just looking at how this works from a Northern Ireland perspective, for those of you who are looking at moving goods to or from, there's not really a lot of difference for goods moving from Northern Ireland to Great Britain. No extra documentary checks. Things should move. There's no requirement for a customs declaration. Goods should move pretty much as they do now. It does say at the bottom that only in extremely limited circumstances would there be any additional processes or documentation to be applied. But it says there something like endangered species, where there might need to be some kind of extra documentation and certification to move the goods. So NI to GB is no real issue. Moving goods from GB to Northern Ireland will require customs declarations, and you've got to look at goods deemed to be at risk of moving across the border to Ireland which may attract tariffs. Now, this is still a little bit up in the air because the term goods which are considered to be at risk of being moved from Northern Ireland into the island, the Southern Ireland, deemed to be at risk. There's no definition yet of what those goods might be. So it's a question of watch this space as far as that goes. But there is a new system, the Trader Support System, a new portal, electronic portal for businesses who are moving goods to Northern Ireland, which is set up to ensure that if you register with the Trader Support System, the portal will guide you through the requirements of getting goods into Northern Ireland, and it's a free service. So anybody involved in that area needs to be looking at being registered, or should already be registered, seeing as we're so close to the 1st of January as we speak. So we've got the transitional arrangements. These are arrangements that are going to be in place from the 1st of January, when we leave the customs union in its entirety. If you're moving non-controlled goods, you do need to make customs declarations on import, unless you take advantage of the transitional 6-month period. Now, essentially, without going through all of the bullet points on there, safety and security declarations, the entry summary declaration that is normally required on import, will be suspended for that first 6 months. Customs declarations may also be suspended. If you as a business decide that you don't want to start making declarations from day one, then you have the right to actually put the declaration information in your own records, and you have up to 6 months, up to the 30th of June, to make a supplementary declaration to catch up with everything you've brought into the UK from the EU. By the way, this is not for third country imports, it's only for the EU. And you can make one supplementary declaration at the end of that 6 months, should you need to catch up and pay any duties that may be due. Now, it may look quite attractive getting the cash flow from that, but obviously there's a fair bit of work for you as a business to keep on top of the declarations that are coming in, maintaining the records that you need to, and making that final supplementary declaration. The final supplementary declaration has to be made by somebody who is authorised for simplified declaration procedures, and that would be, for those of you who don't know, Customs Freight Simplified Procedures, CFSP it's referred to. You have to be authorised for that to make a supplementary declaration. So if you're doing it yourself, you need to have that authorisation. Doing your declarations yourself, if you're using an agent, then they need to have the authorisation in place themselves. From an export point of view, it says at the bottom there, the very bottom, UK safety and security declarations will be required from day one. That's the 1st of January. But it must be said that the safety and security declaration for exports is not usually a separate declaration as it is for imports, and is the responsibility of the carrier to make that declaration, not you or your customs agent. For exports, the safety and security declaration is covered by the export declaration under the national export system anyway. So there isn't a requirement, apart from in very exceptional circumstances, to make that declaration. From the 2nd of April, if you're involved in animals of product origin, products of animal origin, the usual suspects, meat, honey, milk, so on and so forth, you will require from the 1st of April 2021 to start doing pre-notifications and having the relevant health documentation in place. And there may well be physical checks conducted at the point in destination up until July of 2021, which is the 3rd stage that I'm coming on to. So traders moving any goods will have to make full declarations at the point of importation, and pay any relevant tariffs. Full safety and security declarations will be required for imports, and if you're involved in phytosanitary areas, must arrive at the established point of entry with the appropriate border control post. And the government have publicised to some degree where those border control posts will be, where you may need to present the goods for physical checks. So from the 1st of July, essentially, it means that we are a third country outside of the EU. All of the transitional arrangements have gone, and import and export declarations fall into the same category as they will and would for third country imports. That's the day when the curtain comes down, as from the 1st of July, sorry. And you might have heard about the Goods Vehicle Movement Service. This needs to be in place, and it's still not yet authorised and up and running, but it has certain facilitations that need to use GVMS from the 1st of January. But from the 1st of July, it should be in place, and all imports and exports, transit movements at border locations which have chosen to introduce it, it will be live. And sort of finally, the border operating model. Now, you may have seen the publication. It's the second major publication of the border operating model that the UK government has brought out. It contains very detailed information covering a whole host of different types of products and the requirements that will be in place, both during the transitional period up to the 30th of June and beyond that, and details some of the new technical situations that the government are introducing. Published in October 2020, there was a previous one in July, so please, if you're going to have a look at this or you're going to download it, then make sure you get the latest version, which is the October 2020 version. 271 pages, so there's an awful lot to get through there, but obviously as a reference document, it's something you can use to identify the areas that may change for your business from the 1st of January or additionally from the 1st of July. Very useful, goes into an awful lot of details. 5 different sections in there covering import and export requirements for all types of goods and facilitations. It also has the different stages of the transition from the 1st of January, from the 1st of April, and from the 1st of July in a lot more detail than I've actually covered in this presentation today. With that, I'm just about ready to take questions, but first of all, I just want to say that whilst this is looking at some of the very basic customs requirements and some of the impacts that Brexit brings to us, there's another workshop on the 10th of December, Thursday the 10th of December, which I'll be talking about customs special procedures. And these are the areas that are proving very popular in mitigating any additional costs that Brexit might bring to your business by way of processing goods, storing goods, importing and exporting goods. So it will be a very useful webinar for those who are involved in importing and exporting, to see if there are any ways to either save money from the import and export duties that you might be liable to from the 1st of January, or even just to help with cash flow and perhaps help speed up the movement of goods at the border. So I think with that, I can start taking questions.
Thanks, Keith. We've already got lots and lots of questions coming in. First one, in the case of valuation, if we're importing goods from a sister factory in the EU where we have a transfer price, but the deliveries to an end customer in the UK where we have a separate sales price, which price should we use for the export and import declaration?
I would say under those circumstances, as long as the intercompany price is fair and at a market value, then you could use that. You have to be able to demonstrate to customs, though, that when there's transfer pricing involved, that the value of the goods is not deflated. Now, you shouldn't really need to pay import duty, which would include the profit element of you supplying it to the other UK company. That would be my take on it. So essentially, if the transfer value from the associated company is a market value, a kind of market value, a cost that you can identify readily, you should be able to use that import value for the goods coming in. The danger, obviously, from a customs point of view, from an HMRC point of view, is that that value is suppressed in some way, shape, or form. So you do need, and this is an area to be careful about, you do need to have calculations in place to demonstrate that it's a fair and reasonable import value that you've used.
Thanks, Keith.
Second question. Do you need a duty deferment account if you are using a freight forwarder / customs agent?
Not necessarily. You can, and forwarders and agents in the main have their own duty deferment accounts in place. So your arrangement with the forwarder or the agent may be that you will use their deferment account. Now, obviously, that's fine. That's something that happens now. But they will levy a charge to you for that. So if you're using their deferment account, it increases the value that they've got by way of a deferment account. And currently, because there are guarantees in place as we speak, it may have cost them more money. So there's no problem with using the deferment account of your forwarder, your agent, if that's what you want to do. My advice would be, if you're becoming a regular importer from the 1st of January, get your own deferment account, especially at the moment, because it's free of charge. It also has a knock-on bonus that it helps you with your accounting process, and that you're in total control of everything that's coming in through your deferment account with regard to the payments.
There's another question on the country of origin and how this is applied. If we get given steel by our Belgian customer, who sends it to us from France into the UK, then we perforate it, so we put holes in it, send it back to Belgium. How do we value whether us processing it by putting holes in it now makes it UK origin, or because all we did is put holes in it, is the country of origin still France?
Yeah, this can be a tricky area. In a lot of cases, we're in a little bit of limbo here because we haven't got an agreement between the EU and the UK on how preference is going to work. As we speak at the moment, those goods would, the accumulative values that were added between EU member states all come under EU origin, which is what we're looking at the moment. We haven't got the guidelines for how the UK is going to perform after the 1st of January. Hopefully this will be part of the agreement, but let's just take worst case scenario. If you're importing goods from the EU, they're provable as EU origin. If you're adding some value to those by way of a process, in usual terms, the trade agreement will dictate what percentage added value to those goods will mean the goods can qualify as UK origin. That can be quite tricky. I use, just as in general terms, a sort of 60-40 split. It could be a 55-45 split. But if your added value of the process that you carry out on the goods equates to more than 50% of the finished value of those goods, it probably will qualify. But if it doesn't, then it doesn't change origin. I can't be more specific on that because the rules of origin at the moment, which are signed agreements within the EU, are not in place for the UK, and we're waiting for the government to come back to us with how that's going to work.
Thanks, Keith.
Yeah.
Next question. In the case of valuation, if we are importing goods from a sister factory, in the EU, where we have a transfer price, but the delivery is to an end customer in the UK.
I think that was the first one, Aaron. Yeah,
that was the first one. Let me do this one here. I use a customs agent freight forwarder in order to make my customs declarations. Will they provide the commodity code for my goods, or do I have to give that to them?
No, the commodity code is always the responsibility of the importer and the exporter, but more so for the importer because of the values that are attached to the import duty and VAT that needs to be paid. I get this quite a lot. In some cases, a freight forwarder The freight forwarder should never be giving you the commodity code. You need to give it to your freight forwarder. So it's in a nutshell, it's your responsibility. Quite often, I'll get businesses who say to me, "Well, look, our supplier tells us that this is the commodity code. Can we use that?" The answer to that is possibly. It's certainly a good lead into establishing what the commodity code is, but bear in mind that on an import, with the relevant duties and taxes that are charged, it's you as the importer who is responsible for the commodity code. So it's your responsibility to make sure it's correct. HMRC will not go after your foreign supplier if an import declaration has the wrong commodity code on. They'll come after you. So it's an area that really, I think I touched on during the presentation. You need to have a look and review the commodity codes that you have in place. This needs to be done reasonably regularly, just to make sure that you've got the right commodity codes. And in some cases, they haven't changed, because they can change according to the way HMRC wants to collect their data.
Thanks.
Next question. With regards to Incoterms, can we still trade Ex Works with the EU? One of our customers in France has asked us to trade FCA from January.
You can still trade Ex Works, and they've probably asked you to go FCA, because under FCA, the responsibility for the customs declaration shifts. There's no reason why if you want to stick by your guns, you have an agreement in place, there's no reason why you can't still operate Ex Works. It's really a business decision between both parties as to what is reasonable and what each of the parties involved is willing to take on board in order to keep the movement of goods and the contract in place during from the 1st of January, essentially. But Ex Works is still something that's frowned on quite a lot, but it's still something that's available.
Thanks. Next question. Is the value of imported goods on the customs declaration not just the price that I paid for them?
Yeah, I think I touched on that. It can well be, and in over 90% of the cases, the transaction value, which is the first of the 6 valuation methods, is the method that people use. It's quite simple. If you've bought some goods from an overseas supplier, and that will include the EU from the 1st of January, then if those goods are delivered to you, the only cost to you is the invoice value that you've paid for them. And that's the value that would go onto the customs declaration. I think I touched on it earlier on in the sense of that only varies when you might have some responsibility for extra charges for those goods getting to your premises. It can be a little bit tricky in the sense, if you have to insure the goods, you need to include that in the value over and above the cost to you. If you have to pay for some of the transport of the goods up to the UK border, you would need to include that. But without getting too complicated, there are various other additions that you might need to consider if you were, for example, having to pay some kind of license fee outside of the purchase invoice that you got, or a royalty at some stage, maybe on an annual basis, to the company for using their product. That also needs to be apportioned under the value. So in most cases, I don't want to frighten people off that, but in most cases, the transaction value is the cost that you've paid for it. But just bear in mind, HMRC are very focused on checking that the invoice value and the payment that you've made is coincides with what's on the import declaration.
When exporting to the EU, is our GB EORI number enough, or do we need an EU number for each state? We have been advised we need one for any state the goods pass through.
No, and the answer to that is no, yes and no. If you're importing goods, if you're responsible for making an import into the EU, the GB EORI number is not valid from the 1st of January. So you get into areas here where we talked about the Incoterms being variable, and you may want to discuss with your suppliers and customers. You need an EU EORI number from one of the member states to be able to make a customs declaration. The GB EORI number will work now. If you're sending stuff into a member state now, well, you don't need an EORI number, but you can use the GB EORI number. That finishes on the 1st of January. So you need, in some way, shape or form, an EU EORI number. Now, you can use your customers if they're happy to be the importer of record into the EU, or you then get into some of the tricky areas of having a fiscal representative or some kind of footprint in an EU member state whereby you would qualify for an EU registration, EORI number, VAT number. Now, the added bit to that, I think, was to do with goods passing through different member states. Once goods are in, we now would look at the 27 EU member states as being the EU from the 1st of January. It's the same now with the UK. Once you've imported goods using a valid EU EORI number, those goods, providing they're in free circulation, you've paid all of the duties at the border, are can move across EU borders without the need to have a different EORI number for every member state involved. That's how it operates now. All that's going to happen is the GB is stepping, the GB EORI numbers falling out from that, but you do not need individual EORI numbers if you're going from France through Germany onto Italy, whatever that might be. One EORI number is sufficient to get you the goods into the EU 27 member states.
Another question has come in. Some customers have multiple sites across the EU. So, for example, we sell to a UK customer, so there's no issue there with UK to UK trade. However, we also sell to the same UK customer but ship goods to their EU plant. Who is responsible in this situation for those export declarations? My company or the UK customer we sell the goods to?
I would say that your responsibility ends because you've sold them to a UK customer. In a normal course of events, the fact that you're actually shipping them to an EU member state is the responsibility of your UK customer to get the export declaration in place. Those title to those goods changes when you sell them. They become the exporter of the goods and the importer into the EU. Essentially, you're acting in some way, shape, or form like a freight forwarder. And if that UK company that you'd sold the goods to wanted to get the goods to their EU customer, then they would usually use a freight forwarder who would do the import and export and import declarations on that UK company's behalf. So on the face of it, I would suggest that it's the UK customer you've sold the goods to who will be responsible for moving the goods and making the declarations out of the UK and into the EU.
Next question. We bring various goods from suppliers in Europe, but all the goods are the responsibility of the suppliers to be delivered to our door. So are they responsible for this, or do we have responsibility if they fail to complete the correct paperwork / process? And if so, how do we protect our company?
Yeah, the answer to that is, yeah, it's their responsibility. If they're delivering the goods to your door, that's the in-court term that I mentioned early on in the presentation, delivered duty paid. Essentially, that puts the onus on your supplier to do all of the paperwork and pay any of the relevant duties and taxes, import and export declarations to get the goods to your premises. Now, that's as it stands. A lot of companies I've spoken to are trying to take a practical view of this and perhaps offering their services, which is not strictly, it's more like delivered at place, DAP, which is another one of the in-court terms. But of course, that needs the two parties to renegotiate the terms of trade and the in-court term. But certainly, it's their responsibility to get the goods to you. But if practically that's going to cause you as a UK company some problems because the goods are either going to be held up and they haven't got the wherewithal to do that, have a conversation with them and see if you want to offer yourself up as the importer of record, which may mean you making a customs declaration or import into the UK. They can be responsible for the export declaration out of the EU. That shouldn't be too difficult for them. but you could offer your services as the UK company, as the importer of record. But bear in mind that would incur a little bit of extra work in making the declaration, a little bit of extra cost to you as a business of paying for that declaration to be made and paying for any duty and VAT that might be attached to that. So my advice in these circumstances is to have a conversation with your supplier, explain to them that in order to speed things up and to help the process, you're willing to act as the importer of record, but come to some agreement with how the extra costs you're going to have to bear can be repatriated.
I think we've got time for a few quick questions before the comfort break. So one here, if we buy polymer from the EU and after manufacturing it into plastic bottles of sales, that polymer was say 60% of the sales value, is the country of origin UK or is it EU?
On the face of it, that would sound to me like it would qualify to change and the origin would be of UK origin because of the value, the added value of the process from the raw materials. If it's 60%, again, we would have to have a look at the individual agreements as they come out. But that, to me, on the face of it, would qualify as goods now being of UK origin.
Okay, just one more very, very quick one. How do I find out what duty I'll be charged on my goods from the EU?
The UK global tariff. Now, be a little bit careful here. The UK global tariff, if you put that into a popular search engine, in that phrase, it will come up and you can check what the duty rates will be from the 1st of January according to the tariff. The reason, the slight sort of word of warning was I did go to a company who said they'd checked all the duty rates. They were exactly the same as the EU's, and they'd made the mistake of accessing the EU tariff, whereby you're obviously going to get the same duty rates. But the UK one is different. So make sure that if you have commodity codes, you're happy with them, go to the UK tariff checker, UK global tariff checker, and it will tell you what the duty rates are for those goods by commodity code when you bring them in. And I think I also mentioned it has a quite handy comparative whereby it will show you that if the goods coming in on the UK tariff are nil, it will show you what the previous EU tariff would have charged you had they maintained that.
Super. Thanks very much, Keith, for that.
Okay.
So we'll take a very short 5-minute comfort break. But don't worry, any questions that haven't been answered, Keith will come back to you via email after the session is over. So quick break and then we'll back for the second workshop on EU travel and immigration. Thanks.